once again, my name is Andre Sospina. I direct the Charter Membership Program and our PitchDecks.com division. If more than welcome to have our panelists come up on stage now. Go ahead, grab a seat. Thank you very much. I will also be your master of ceremonies today, as well as moderating panel 1. But I always like to get a little feedback from the audience in terms of the type of deals and industries that you're representing. So with a show of hands, can you please raise your hand if you're representing a real estate firm or a real estate deal in any asset class, nice and high? Fantastic. How about software? Software companies? Manufacturing? A few hands. Oil and energy? Excellent. Agriculture, including cannabis? Fantastic. And fund managers? I'd like to see just fund managers, nice and high. Excellent. Thank you. So round of applause for everybody here and for our panelists of the day. I asked for a lot of participation. I'll ask you to clap. Hope you guys don't mind, but thank you for being here. Thank you to all of our members, our sponsors. And one last raise of hands if you and I have spoken on the phone or have exchanged an email. Excellent. Great. Thank you. So today's first panel, will be private investor preferences. What legal structures, fees, and models are preferred right now? So I'm going to give each panelist a quick 2 minutes to please let us know your name, the firm you're representing, and just a little bit more about yourself and your industry. So we can start with Roddy, please.
Good morning. Is that working?
Yes.
Good morning, everybody. Yeah, I'm Roddy Balfour, and I've been a fiduciary for many, many years, and I'm now part of the Equium Group, which is in 16 or 17 jurisdictions, and so we look after people from all sorts of countries who are investing in the sort of LLPs that you are running. Now, I'm not here to talk about running LLPs in the United States, but I think there is a general lack of awareness about what is happening in the offshore world and what is happening to those clients who want to invest into the US, into your LLPs. And so I'll be talking a little bit about the new substance rules that apply to all the offshore jurisdictions, to the common reporting standard, which is the automatic information exchange. Neither of these things apply to you in the US, but they apply to your foreign investors. So delighted to take questions on that at any stage. Is that enough?
Thank you. Yes. Randy.
Good morning. My name is Randy Abels. I'm with RSM, the accounting and consulting firm. I'm a specialist in family offices on structuring, working with family offices. I spend most of my time now consulting with family offices and private investors on how to really structure themselves, what's the best structure, how they want to really do the investment, and right now the big thing, especially with the family offices, most of them are going to direct investing, which has become very popular, and I think that's a good opportunity for a lot of people in this room. And the other thing is, we work with them on some of the due diligence and anything else that they need, but the private investors and family offices, especially the intersection with private equities, become a very healthy market.
Thank you.
Peter Collins. I'm from Florida. I'm in the private equity real estate business. We sponsor funds raising capital, investing capital in multifamily and commercial from Texas to the Atlantic, north to Virginia and Tennessee. Been in this business for about 22 years. Have many high net worth investors. Also serve on a couple of large endowments and pension fund boards. I chair the State of Florida Pension Fund Board, and I also chair the Florida State University Endowment. Enjoy coming to these because of the people in the room, obviously. We don't invest up in this area, but we have several investors from this area.
Excellent. Thank you.
Good morning. My name is Liz Siggety, and perhaps I'm offering some diversity on the panel, but maybe not in the way you think. I'm an angel investor, so the investments that my group, which is Delaware Crossing Investor Group, invests in are very early stage. I've participated in a couple of these conferences over the last few years because I think family offices are getting more and more interested in this asset class, which is highly risky. And very different than, I think, the traditional asset class for family offices. I founded Delaware Crossing about 15 years ago. We are regional investors. Delaware is the river. You know, Washington crossed the river. We invest on both sides of the river, including New York, Connecticut, New Jersey, Pennsylvania, and Delaware. So if you are an emerging company, you need to be located there. I'm also the co-chair and the national co-chair of the Emerging Companies and Venture Capital Practice at Fox Rothschild, which is a large national firm, and I represent emerging companies and, in some instances, family offices that are investing in that asset class, as well as institutional and, super angel investors. So that's me.
Thank you. I think, each one of you should have a microphone, right?
Well, good morning. I'm Holland Sullivan, and I work from inside a family office. I have run a single-family office for the nicotine patch inventor previously, and currently work in a multi-family office structure with George and Scott Register out of Atlanta. Our focus is primarily in manufacturing. Very interested to speak with some of you in that space. We make a lot of direct investments and also facilitate other families joining us in JVs. A lot of cross-border factory relocations, by the way, jobs created in America as a result.
Thank you.
Hey, good morning. My name is Chris Benson. I'm the Chief Investment Officer for Reliant Real Estate. We are a commercial self-storage operator out of Roswell, Georgia, not too far away from you. We are vertically integrated. We buy and manage the facilities across the Southeast. We're the 25th largest self-storage operator in the U.S. And I think from my perspective on the panel, like you, Peter, we have a number of high net worth individuals who have invested alongside of us. And so I think the structure in which we try to develop our deals is to create mutual incentives. And that's what I'm trying to share with you today.
Excellent. Thank you so much. So one more time, round of applause for our panelists before I start drilling them with questions. Excellent. So I definitely want to start off with a lot of conversations. Actually, before I start, I know that there's some people sitting. We got a standing room only. But we do have a good amount of seats here in the first 3 rows. So don't be shy. Feel free to come up and find yourself a seat during the panel. So from there, a lot of discussions have been around, are investors providing debt or equity? And we've seen a growth in interest in providing debt investments over the last decade. But with your portfolio specifically, do you most often invest on the debt or the equity side now, and why? And I'll start with Elizabeth,
Well,
the angel investor.
Is this on?
Yes.
All right. So angel investors, obviously, the companies can't get a classic debt investment. They often don't have revenue, especially in the life science area. In the technology area, it's very, very early stage revenue. So I'd say no, except we do often invest in convertible debt. But really, the play on convertible debt is that it's going to convert to equity, and that's really all the angels care about. So. Excellent.
Thank you. And Randy, I know you serve hundreds of family offices. What are you seeing more often?
Well, our families go across the gamut in size and individual investors. There is more of an appetite for debt as people are chasing returns, assuming they can get comfortable with the due diligence. But I also agree, convertibles are very attractive because they're really looking for the equity. A lot of people now are doing more of, I won't call it the Uber type investment, but the investments where, they know there's a big risk, but there's also a big reward. A lot more people are doing those type investments, especially the very wealthy, as they're looking to expand their portfolio, called cannabis or whatever you want. But the big thing with a lot of the family offices now, they do not like a lot of them paying the fees, and they're looking to bring it inside. The other thing I've noticed with a lot of the families, they don't like the fact that they go into an investment, let's say private equity, and it's going to be flipped in 5 years. A lot of them look for more of a long-term hold where they want to really be in it for a lot longer in the investment.
Great. Would anybody like to work off what Randy said? Or I can pick.
Well, I could follow on that. wonderfully boring investment that we've been involved in New Mexico, a rubber glove factory. I mean, I'm going to win for more boring.
I'm sorry, that was
guy
in
of the
New
day.
Mexico?
That's in New Mexico, yes.
And what type of factory? Sorry.
It manufactures rubber gloves.
Rubber
It's
gloves.
literally the most boring product in the world, but the margins, without giving too much away, are quite substantial and quite attractive. So obviously, we favor equity, we favor buy and hold, and we don't want to sell that unless it's worth more to someone else in their hands.
Got it. Excellent. And Chris, you were talking about structures right before, during your introduction.
Yeah, I think we've definitely seen some more interest from the institutional investor on the debt side as we've gotten later and later in the cycle. I think to your point, Gert, around if they can feel comfortable with the underwriting, it certainly provides a different risk profile on the debt side, at least in self-storage. Self-storage is one of the asset classes that performed really well in the last recession and did not see a significant number of those properties being returned to banks. So, typically we've seen that, but our investor base, primarily the appetite for the scale of returns they're looking for, usually requires them to be on the equity side. With interest rates where they are, debt is very cheap right now for an operator like us, so it's hard to, make that play between the equity and debt with our investors who are looking for a little bit more meat on the bone as far as the returns are concerned. So I think it really depends on what the group's interests are and what their mandates are as far as the return profile.
Excellent. Yes,
The
Peter.
other thing I would say is being in the real estate business, if you're new to direct investing, and if a lot of you out there are direct investing, and if you're not investing through funds, especially in real estate, especially in the cycle that we're in, I would look at it. I would look at either mezzanine or preferred equity. I think that the returns look good, right? Development returns. I make some great looking spreadsheets, right? But I would tell you from a risk standpoint, you can do just as well in preferred equity or mezzanine with less than half the risk. But it's difficult to do on a direct basis because you then have to go find that right group, right? You're then sourcing deals, you're then doing due diligence on those teams, and so it's somewhat difficult. We have more and more people coming to us, funds coming to us wanting to invest mezzanine or preferred equity. And just aside on the real estate side, if we're going to get a senior loan, the reason why if a recession comes, I don't think it'll be anything like it was in 2008 is because the banks are still somewhat under control. And most of it has to do with HVCRE, high volatility commercial real estate loans. It's a provision that says you can't go over a certain percentage of debt. Well, that debt includes mezzanine, so there are many, many more preferred equity structures out there. So what I would tell you, you're going to have to do that due diligence of those individual teams, which if you're in a group that's doing that, great. But if you're not, that's your biggest, I think it's your biggest pitfall. It's not necessarily the structure, it's the team. You can have a great structure, but a terrible team, and you don't know it till it's too late.
Great, thank you. And Rod, you, with your kind of international perspective, what would you say in terms of debt versus equity type investments? What are you seeing more of, especially amongst your clients and the families you're working with?
Yeah, yes, I mean we've seen quite a lot of investment inbound into U.S. real estate, tending to be from very wealthy families, and we've had some hybrid structures where we've used portfolio debt, which is in fact using debt from offshore trusts to help finance, and there's a complicated structure that helps to avoid FIRPTA. Although since there have been some tax changes, and I'm not sure how totally effective it is, but these are the things that many of our clients want to really dive deep before they actually make the investment and see how they can optimize their U.S. investments.
Okay, got it. Excellent. Thank you. And getting right to the juice of it all, what, and as specifically as possible, please, what type of deal flow, investment manager, or direct investment would you like to source by being here on this stage today? What would you like to see? So I'll start with Chris at the end. Self-storage, of course, but if you can elaborate.
I mean, for us, certainly the deal flow on the self-storage side is always critically important. People have opportunities to bring us potential off-market deals is always interesting. I think the purpose of me being here is certainly on the equity side, so we're always looking to diversify our equity partners. So I think that's probably my number one priority. We're in the midst of raising a fund, and so we're always looking to diversify our investor base.
And amongst all the different self-storage deal flow that you see out there, what differentiates one than the other? Let's say if they're even geographically similar.
Differentiate from an operational standpoint or just the property opportunities?
Yeah, from an operational standpoint.
Well, I think the operationals are probably pretty similar. I think in storage right now, you've had a significant development cycle over the last 3 years. Storage performed really well in the last recession, as I had said. So behind that came significant development as people tried to capitalize on that. I think for us, where the value still is we're trying to differentiate ourselves as where we're operating. So primarily we're operating in secondary and tertiary markets. It's where we have the opportunity to still create value. And while many people have gone out and done ground up development, our sweet spot really has been around value add. So the ability to acquire a cash flowing asset up front and then doing something that's creating value, a forced depreciation play. And that may be a construction component, that may be adding some ancillary income items. The interesting part about storage, maybe a little bit different than multifamily, is there's still a significant number of operators that are mom and pop, right? So you have 1 or 2 facilities, and so the consolidation roll-up strategy that exists in the self-storage world is really where we see kind of our long-term opportunity.
Great, thank you. And Roddy, I know that you had mentioned that you saw a lot of investment in United States real estate. Anything outside of real estate that some of the families you're working with, investors, ultra high net worth individuals are definitely looking at out here in the United States?
Yes, definitely. I think they still see this as the land of opportunity. But most of the people we look after are entrepreneurs, and they're not great at, they don't enjoy stock market investing. They do like to buy real assets. And one of the interesting things you were talking about, angel investing, quite a lot of them are very happy to be angel investors and recommend to us as their trustees that we make a modest investment, because obviously we have a different duty as fiduciaries. But one of the difficulties is, in fact, finding any packages of startups through any of the traditional investment management houses.
Any specific industries?
No, it's usually something that they know about, and they could have been paint manufacturers, or they could have owned fishing fleets, or any sort of thing, winemakers, etc.
Usually in the form of funds.
Well,
usually,
no, they want to invest, but they don't necessarily want to go and do a complete angel invest in. They want to have a diversified portfolio of startups in a small way, but. It's very difficult to achieve through traditional money managers.
Got it. Excellent. Thank you. And I guess on the topic of angel investors, Elizabeth.
Sure. So Delaware Crossing Investor Group is an angel investor network, which means that we have about 40 members, which is what we want to have. And they all make their own individual investment decisions, but there's an application process, and the screening committee brings the companies that it chooses to the membership for their investment. And it is best when you're an angel investor to have a portfolio. Good thing about, to follow up on your point, the good thing about being in a group is it prevents you from making stupid decisions because there's other people in the group that know more about that industry than you do. We are industry agnostic. What we look for is companies that really are in our region, because that's our mission. Our founders, our members, a lot of angel investors are motivated by, certain causes or missions. Ours was they wanted to support entrepreneurship in this region. So that's why we are what we are. We want something that'll exit and make us money. We don't want a service business. We actually don't invest in real estate. We don't invest in entertainment or media. And we want something that will exit. Good management team and a model that's defensible, solving a problem, and that somebody else can't do it really easily. So, in a good market. We want everything, basically.
Yeah.
That has to be perfect.
But
it takes work, but it's fun. You have to like it.
There's also things you said you guys aren't investing in. So I guess if you could just elaborate a little more on what you are investing in. I mean, obviously, I'm assuming technology is definitely on that, but technology is a broad topic. So, like, what within technology would you guys say stands out for you, especially that you've seen?
Well, I think we prefer usually B2B. Sometimes we'll look at something that's a B2C model. When it's technology, we want them to have either a strong paid beta, preferably paid beta, or really strong customers that will attest to them, but usually we want some sort of revenue, and that's our proof of concept. For life science, and remember we're also down in the Philadelphia area. Philadelphia has amazing life science companies. It's a hub in the United States, so those are obviously pre-revenue. Maybe they're phase one, maybe even pre-clinical. So. But recently we've done some nano, we've done some sort of engineering-based. Often they'll have some sort of intellectual property, which makes them defensible. So it's usually technology or life science. But we did invest in a rum company once, lost our money, but it was fun.
Yeah. Go ahead.
Can I just ask you a question? Have you been going long enough to have a sort of established attrition rate? I mean, i.e. of failures? Because this is...
Oh, we get a lot of failures.
But what sort of percentage would you say? Have you been going long enough to just say we're prepared to do this to basically lose 20% of our money each year and hope that the other 80 make up for it? Or
Well, the learning in the industry, and it's surprising, Delaware Crossing has followed the learning, is that half of the companies you invest in will fail. And so you got to be able to deal with that. And when I invest, and I've invested in 40 or 50 companies, but very small amounts, it's a portfolio. And I think that's really the best way to do it. So half of the companies fail, maybe 6 and 7, you get your money back. 8, maybe you get 2, 9, you get 5, and then we had the 17. If you figure out the math, you're making money. We had a huge exit a couple years ago, and then we had a 5er, 6er. Last year, we have another one coming, and that's the way you do it. But half of them fail.
I would say too, going on that, we have several investors of ours who have been high net worth individuals that were very successful in building a business, and they think because they were very successful in building that business, they can identify other opportunities that's outside their sphere.
What
right?
industry were they in?
Well, it doesn't matter. Some of them were
I'm just curious.
Some of them were money managers, right? We've got some very savvy money management people, but that have never operated a piece of real estate, right? Except their house.
But they
right?
think because they're managing money.
But they think because, hey, look, I'm making millions of dollars, or I sold my company for millions of dollars, that translates immediately. What doesn't translate is just that specific knowledge of that area. The intelligence is there, obviously. The desire is there. And when you ask, what do we come looking for? I come looking for people that the first thing they say to me is, I don't know a lot about real estate, but I'd like to invest in it. And the first thing I would tell you is the same thing, Elizabeth. Don't go out and pick one piece of property and say, that's my white whale. Right, that's what's going to that's what's going to do it. Yeah. I would say, look, you've got to be diversified. You take a little chunk here, you take a little chunk here. You start out preferred equity, you start out mezzanine debt. Don't go for the home run, right? Just because you've been extremely successful in what you've done doesn't mean you're going to hit a home run in the very next thing you do. I think you got to be cautious. We've been at this 22 years. I've lost lots of money too, right? But our fund is, I've never had a fund that went negative. I've had properties within those funds that went negative, but I've never had a fund. We're top quartile, second quartile, nothing lower than second quartile in Preqin. So diversification is important, but I would just stress, I come looking for people that say, look, I don't know a lot about real estate. I'd like to be invested in it. I'd like to be diversified. And I've had some of the best investors that I've ever had. And I wouldn't say this in a group of pension funds, but 80% of our investors are pension funds or foundations, endowments, not high net worth. They're the least valuable investors I have, right? Because it's just money. They bring nothing to the table. Now, you can argue money's the most important thing, right? And it's the worst part of what I do, but is raise money. But the best deals that I've ever gotten have come from individuals that just pick up the phone and say, hey, I know you're doing this. You should take a look at this.
Got it. So I do want to take some questions from the audience in a moment, but just really quick, just in 5 seconds, geographic areas that you guys are acquiring in. For real
Me?
estate, yes.
We do the Southeast, from Texas to the Atlantic, north to Virginia and Tennessee. Today, we also own about 500,000 square feet in Puerto Rico, which is not falling apart, by the way.
Great, great. Randy, once again, from your wide perspective, what are you seeing? What are the families that you're working with looking for? What are they keeping their eyes
Well, to follow up on
out
your
for?
point, diversification is very important. We take a look at their portfolios. I will tell you, after the last 3 years, hedge funds have become very out of favor. People are dropping their allocations in hedge funds. They're increasing their allocations in real estate, private equity. The other thing, if you work with families that have younger generations, impact investing is still a big deal, especially brought up by the younger folks.
Yes.
And I will tell you, impact investing, there's a lot of different definitions, but the deals are tougher to find, and you're not really looking for economic return, but this is something that the younger generation, so it causes a lot of problems within the families, and this is where governance becomes very important and how the families run themselves.
Yeah, I think that part of what we're seeing even is for the impact investments out there, sometimes the best thing to do is to not go in first stating that it's an impact investment, because for a lot of investors, they're not thinking that that's going to be where the returns are. So to go in with that right off the bat may not be the strongest strategy. Would you agree?
Yes.
Yeah.
I do.
Holland, please.
One thing that we saw when we've been hiring, particularly in Native American communities, particularly
Hiring in neighborhoods?
hiring for employment, we've found that there is an impact effect, and it's very beneficial. Unemployment can be deep into double digits, but the primary driver of it is that there is a large, almost inexhaustible labor force, and things like impact investing or the ESG overlay enhance our diligence process. So when we look at something like governance, if we're bringing a Korean factory owner over, what kind of governance do we have over this U.S. entity? We actually inserted a CFO of our own choosing into that so that we would see some reporting out that was more compliant and familiar to our standards. So I think if you shape the opportunity in a way that's familiar, then I think everyone walks away with a better understanding of what you're trying to accomplish. If I could, what we're looking for, I think
Yes,
that was the
please.
theme. I'll bluntly ask, if you own a factory and would like to see it either relocated or incentivized in ways that might not be currently available, you might be in a fund or you might be a family that has a portfolio company, we have that structure. I'd also say that if you're in an area that's fertile for manufacturing development, we're looking at other states. New Mexico is our focus, but we've looked at Georgia, we've looked actually at Idaho, and my home state of Texas, where I lived for 30 years. I'm a New Yorker for the last 10, though. The wife won on that one. But I am very eager to explore new territories, and we can't perform diligence on 50 states, so we're very interested in those opportunities. Another key bucket that we're looking for, real estate. What we do becomes very land hungry very quickly, and we can enhance the value of land that you buy. So we're happy to partner with those that are interested in acquiring real estate. I'm not going to denigrate the whole opportunity zone phenomenon. I think there's value in it, but I think it's got to be a good deal and a good rationale that happens to have that as a benefit. We have a parcel of land now, 150 acres. We want to buy it. We'd love to have an experienced real estate partner that helps drive that part of it. We'll put the factories on top and drive the true development of it. But that's something we're looking for. So anyway.
Excellent, excellent. So if we can have mics ready, because I do want to take some questions from the audience. We can start if you raise your hand. Great. I saw this gentleman's hand go up first, so I do want to acknowledge that.
Question.
Your name, sir?
Joe.
Joe?
Yeah.
Great, Joe. Microphone's coming to you right now.
Elizabeth, what's the size of your investments per angel?
Per
Individual
angel?
angels, yes.
It's small. It's really small. So per angel, it's $10,000, but we put an LLC together, so we're investing maybe $250,000. But the rounds are usually, I'd say, $750,000 to $2-3 million, and we're part of a syndicate. We work with a lot of other angel groups, so once there's someone leading the investment, it's usually pretty easy to get the rest of the round.
Timeline is what?
Oh, it's long. Everybody's going to love angels by the end of this one. So usually you apply to the screening committee. If you're lucky, you'll get in a month later. And then there'll be a month of due diligence and then maybe a month to close the round. So it's a few months if everything goes smoothly, which it usually does not. But there's no fees, to apply to us. It's completely free. And it's painful, but when it works really well.
Where do I apply?
DelawareCrossing.org.
DelawareCrossing.org. Thank you. Fantastic. Next question.
Thank you. Good morning, Camille Holmesy. My question for Holland is moving factories and repositioning them in different areas of needs for different benefits, tax or for productivity. It requires labor training, management training, and in order to do this, can you give us more details on how do you
Absolutely.
accomplish this and the time frame that it would take?
So it depends on the type of labor that's being trained. So in the case of the Navajo Nation, there are many skilled artisans. It's a very, I'd say, artistic culture. And so fine handwork, that sort of thing, has a long cultural basis. The Raytheon facility in that region has virtually no turnover and excellent results in training up a labor force. In terms of time, what I have been told is 6 months to a year for typical, I'd say, intermediate level factory work. That's not the same thing, frankly, as executive management. Now, the fun part about where I am right now, the lead partner in this process wants to be fired. He doesn't want to be a rubber glove factory CEO. That wasn't his ambition in life. But he would love for someone local learning under his tutelage to rise up and eventually fire him. Kind of, I guess, the Sith Lord approach to executive management. But the idea really is that a lot of the training can only happen on site once you're there in context. I'd point out, too, there are a number, at least in the state of New Mexico, and I'm sure every state has it, programs like JTIP, LEDA, et cetera, this acronym soup of tax subsidies. And if you have a local state partner that affiliates with you, you can very quickly have those costs offset. So you can't necessarily shorten the time, but you can minimize or eliminate the cost.
Fantastic. Thank you. I want to take a question from the middle of the room. And I have someone all the way in the back. Charlie's on it. All right. Fantastic. A round of applause for Alan and Charlie, setting up this whole room, running the microphones. Man. Your name, sir?
Chris Bentley.
Hi, Chris.
For the real estate investors, do you guys consider mineral rights as part of the real estate asset class that produce oil and gas royalties? And do you invest in them?
Peter?
We don't invest in mineral rights. I've never even sold a mineral right from underneath one of our properties. Sometimes we buy the properties and they've already had the mineral rights sold off by a previous owner. It's just not what we do. So just no experience there.
Got it. Anybody else?
Essentially we're the same thing. So typically if it is land that had mineral rights, that it's typically sold before we've purchased it.
Any experience here on mineral rights?
Well, I did see another group that bought many thousands of acres north of the area that we were developing, stalled a bit in their development projects, and mineral rights became a way for them to buy a bit of time. So they were selling coal on their site, and they had a rail spur and some other infrastructure in place to support that. But not in terms of legal structuring, just in terms of a way to buy yourself time while you're further developing a property.
Interesting. Great. Next question. Right here on the wall. Fantastic.
Yeah, my name is Lewis. Just a question. I think it's pretty well known that commercial real estate in New York has come down at least 1/3 in the last year. Residences are not being filled. Buildings are still being built everywhere, downtown Brooklyn, everywhere, Manhattan. What could possibly be the rollover effect of something like this on your operations in general?
Fantastic. Who would like to take this one?
I would say that
just one second. Chris, did you have?
No, you go ahead, Peter.
Go ahead.
we don't invest in the Northeast, but I would say that what he's described is not a distinct phenomenon just to the Northeast. I think there are several parts of the country where that is happening. I think the latest statistics I saw were 3 out of the 4 new apartment buildings in New York are unsold. Certainly there's oversupply. The issue becomes in every market cycle land price in real estate, right? People have to raise the rents to make the land price increases work. Obviously construction has gone up quite a bit. Time of construction has gone up quite a bit because we don't have enough skilled labor in the construction business to adequately, provide the build what we need to build in a reasonable amount of time. So those costs are going up. I think that also, rents seek a peak. There certainly was some capacity, but most of what's getting built is the highest rent stuff because that's the only thing they can build to pay for the real estate. So I don't think that's indicative of real estate all over in terms of there's plenty of stuff getting done that's being done and sold at good prices. But I think the high end is what you're seeing happening. And I think that's going to be not so good for a while.
Fantastic. Any final remarks from any of our speakers here? Last things you want to say? Great. Just want to give that chance. All right. So big round of applause for our first panelists here. But I do got one thing to say before they get up on stage. Thank you so much for our first panel of our... Wait, before you get off stage. So everybody, what I do sincerely, seriously, assertively ask, please, from everybody in this room, as our panelists are walking off stage and being ushered to the networking room, please give them adequate amount of room to exit and be able to go to the room and then have those conversations in the room that we have designated for those introductions and for those meetings and for those communication exchanges. Okay, can we agree on that? Thank you so much, everybody. Round of applause for our first panelist, and I'm going to bring up our next speaker.